Something is coming for the stock market in 2026 that most people are completely unprepared for. And I'm not talking about a small move. I'm not talking about the market going up 3% and everyone celebrates. I'm talking about the kind of market move, the kind of wealth building opportunity that people look back on 10 years from now and say, that was the moment everything changed. The surprising part is that most people are going to miss it, not because the opportunity isn't there, and not because the warning signs aren't visible, but because the opportunity will arrive wrapped in fear. It will be surrounded by negative headlines, uncertainty, and the kind of market volatility that convinces everyday investors to panic and sell just before the biggest gains begin. I'm talking about the possibility of a powerful market melt-up, fast and aggressive rally that often follows periods of extreme skepticism. History has shown that these kinds of moves usually happen when the majority of investors are still expecting bad news. Unfortunately, the people who need these opportunities the most are often the ones who sell too early. That said, I want to be completely honest with you. The road to that opportunity won't be smooth. It never is. Before markets make major moves higher, they usually shake investors out first. There will be sharp declines that feel like the beginning of another financial crisis. There will be weeks when your portfolio drops and every financial news outlet predicts disaster. During those moments, your instincts will tell you to protect yourself by selling and waiting until everything feels safe again. If you follow those emotions, there's a real chance you'll miss one of the biggest investing opportunities of the decade. So in this video, we're going to look at both sides of the story. We'll talk about the real risks that investors should be watching, not exaggerated headlines or social media panic, but genuine risks that deserve attention. Then we'll look at the reasons why I remain optimistic about what could happen next and why I believe the long-term outlook is still incredibly strong. My goal isn't to convince you to buy anything blindly. It's to give you enough information so that when markets become volatile, you'll understand what's happening instead of reacting emotionally. Instead of rushing to sell, you'll be able to think clearly and make better decisions. Before we dive into the data, let's talk about something almost every investor is thinking right now. One of the most common things I hear is the easy money has already been made. Honestly, I understand why people feel that way. The market suffered a painful decline in 2022. Then it recovered much faster than many expected. Artificial intelligence stocks exploded higher. Nvidia climbed from under $200 to well over $1,000 before its stock split. The S&P 500 continued reaching new all-time highs, while financial news constantly warned that stocks were overvalued and a crash was just around the corner. If you've watched all of that happen, it's understandable to believe that the biggest gains are already behind us and that the safest approach now is simply to stay cautious. I believe that's the wrong conclusion. The truth is that wealth isn't built by perfectly buying the exact bottom and selling the exact top. Almost nobody does that consistently. Real wealth is built by identifying the long-term direction of the market and staying invested long enough to benefit from it. Right now, there's a huge difference between how this market feels and what the underlying data actually suggests. Sentiment and reality aren't always the same thing. Negative opinions always receive more attention than positive ones. Headlines predicting a crash generate more clicks than headlines saying things are likely to be okay. Fear attracts audiences, but it doesn't necessarily create successful investors. History has repeatedly shown that investors who allow fear to control their decisions usually underperform those who stay focused on the bigger picture. So instead of listening to emotional headlines, let's focus on the evidence. Over the next few minutes, we'll examine the biggest risks facing the market in 2026. These aren't random predictions or sensational stories. They're genuine issues that could create significant volatility and deserve your attention. After that, we'll go through several reasons why I believe we're still in the early stages of a much larger bull market. I'll explain not only what those reasons are, but why they matter and how they could affect stock prices over the coming years. Finally, we'll bring everything together into a practical framework you can use to make smarter investing decisions whenever markets become uncertain. One idea is worth remembering throughout this entire discussion. The stock market has always transferred wealth from people who react emotionally to people who stay prepared. The better prepared you are, the better your chances of benefiting when everyone else is panicking. Let's begin with the first major risk. The Federal Reserve remains one of the biggest wild cards in today's market because interest rates influence almost every part of the economy. Over the last several years, inflation reached levels not seen since the early 1980s. In response, the Federal Reserve raised interest rates at one of the fastest paces in modern history. Markets struggled with those higher rates, while investors repeatedly expected aggressive rate cuts that kept getting delayed because inflation proved more persistent than expected. Now, heading into 2026, we're in an uncomfortable middle ground. Inflation has fallen significantly from its peak, but it still hasn't fully reached the Federal Reserve's long-term target. That's creating uncertainty about how quickly interest rates can continue moving lower. The biggest concern is the possibility of rates staying higher for longer than investors currently expect. If borrowing costs remain elevated, high-growth companies could experience pressure because future earnings become less valuable when discounted at higher interest rates. Even strong businesses can see their stock prices decline under those conditions. That's why every statement from the Federal Reserve continues to matter. Small changes in their outlook can move markets significantly in either direction. At the same time, it's important to remember that central banks generally want stable economic growth. Their goal isn't to create a recession. While the path may be uneven, many investors still expect interest rates to trend lower over the longer term, which could eventually become a positive catalyst for stocks. The second major risk is geopolitics. It's easy to get overwhelmed by global headlines because every week seems to bring a new crisis somewhere in the world. Instead of reacting to every headline, it's more useful to focus on the situations that could genuinely affect financial markets. One of the biggest areas to watch is the relationship between the United States and China, especially when it comes to Taiwan and the global semiconductor industry. Modern technology depends on advanced computer chips. Smartphones, artificial intelligence, cloud computing, electric vehicles, and countless other industries rely on a steady supply of semiconductors. Any disruption in that supply chain, whether through political tensions, trade restrictions, or military escalation, could create significant volatility across the technology sector. We've already seen how quickly chip-related news can move major technology stocks. That possibility isn't disappearing anytime soon. Another important area is the global energy market. Oil prices influence almost every part of the economy. When energy becomes more expensive, transportation costs rise, businesses face higher operating expenses, consumers have less money to spend, and inflation becomes harder to control. If oil prices experience another major surge, it could slow economic growth while making the Federal Reserve more cautious about lowering interest rates. That combination would likely create additional pressure on stock prices. Europe is another region investors shouldn't ignore.